The foreign exchange market remained in focus during the latest trading session as the USD VND exchange rate declined to 26,312.0000 on July 22, 2026, marking a modest 0.01% decrease from the previous trading day. Although the movement was relatively small, financial analysts noted that even minor fluctuations in a closely managed currency pair, such as USD, VND can provide valuable insight into broader market sentiment and the overall health of Vietnam's economy. Over the past month, the Vietnamese Dong has strengthened by 0.05% against the US dollar, reflecting stable domestic economic conditions and continued confidence in Vietnam's monetary framework. However, when viewed over a 12-month period, the Dong remains 0.62% weaker than it was a year ago, illustrating the longer-term impact of global financial conditions, stronger demand for the US dollar, and changing interest rate expectations in international markets. Market participants believe that, while short-term movements continue to be influenced by daily trading activity and external developments, the Vietnamese currency has maintained a relatively stable performance compared with many regional currencies, supported by disciplined monetary management and resilient economic fundamentals. Investors continue to monitor Vietnam's export performance, foreign direct investment inflows, inflation trends, and industrial production, all of which play an important role in shaping confidence in the country's currency. At the same time, expectations surrounding U.S. monetary policy remain a key driver of global currency markets, with any shift in Federal Reserve policy capable of influencing demand for the U.S. dollar and affecting exchange rate movements across emerging Asian economies, including Vietnam. Financial experts explain that the USD VND spot exchange rate represents the current market price at which one US dollar can be exchanged for Vietnamese Dong for immediate settlement, making it the benchmark used by commercial banks, importers, exporters, financial institutions, and individual investors conducting day-to-day currency transactions. Because the spot rate reflects real-time supply and demand, it changes continuously throughout the trading sessions, as market participants respond to economic news, capital flows, and changing investor sentiment. By contrast, the USD VND forward exchange rate is an agreement established today for the exchange of currencies at a predetermined rate on a future date. Forward contracts are widely used by international businesses to manage currency risk by locking in an exchange rate before future payments are due. This allows exporters and importers to reduce uncertainty and better plan their financial obligations, particularly during periods of increased volatility in global financial markets. For example, a Vietnamese exporter expecting payment in US dollars several months from now may secure a forward contract to guarantee today's exchange rate, protecting future revenue from unfavorable currency movements. Likewise, companies importing machinery, technology, or raw materials from overseas can use forward agreements to stabilize costs and improve long-term budgeting. Analysts emphasize that understanding the distinction between spot and forward exchange rates is increasingly important as international trade expands and businesses seek effective strategies to manage foreign exchange exposure. Market observers also point to Vietnam's continued economic growth as a key factor supporting confidence in the Vietnamese Dong. The country's manufacturing sector remains one of the strongest in Southeast Asia, benefiting from expanding exports of electronics, textiles, footwear, machinery, and agricultural products to major international markets. Vietnam has also continued to attract substantial foreign direct investment as multinational companies diversify their global supply chains and expand production capacity within the country. These investment inflows increase demand for the Vietnamese Dong while strengthening foreign exchange reserves and supporting overall financial stability. Economists note that Vietnam's consistent trade performance, prudent fiscal management, and efforts to modernize its banking sector have contributed to maintaining relatively stable currency conditions despite uncertainty in the global economy. Nevertheless, external factors continue to influence exchange rate movements, including fluctuations in commodity prices, geopolitical developments, international trade conditions, and changes in global capital flows. As investors await additional economic data from both Vietnam and the United States, financial markets are expected to remain focused on inflation trends, employment figures, central bank policy decisions, and global interest rate expectations. While short-term fluctuations in the USD-VND exchange rate are likely to continue as part of normal market activity, many analysts believe that Vietnam's solid macroeconomic fundamentals, expanding industrial base, and commitment to maintaining financial stability will continue to provide long-term support for the Vietnamese Dong, reinforcing confidence among businesses, international investors, and market participants alike.